Good morning, guys. Hold on. We'll let you share and
Lovely.
start the recording.
Cool. Awesome.
Hopefully we'll be done shortly. Good morning. There you go. There we go. Got it.
Been committed and that's too close.
All right, I'm gonna give people just a couple of minutes to get in. Hi, everybody. Hello, hello. My in-person people.
Good morning, everyone.
Morning, Danny. Morning. Probably a little more sunny where you are, girl. Not Vanessa.
Actually, it's been raining all day, but it's not cold though.
Oh, that's fair. Did you hear Ramona? She said she doesn't like you.
Come visit me.
Come visit me. Come visit me. Oh.
Hey, better wait a minute.
Oh my goodness.
Stay safe out there, girl.
Maybe on the night flight.
There is a 10 p.m. flight.
That's why she's like, I know exactly what time people can come.
Love that.
All right, just one more minute. While we're doing that, just for those of you, I know everybody in this room, but everyone who I don't know that's on Zoom, I'm Kelsey Curtis. I am a certified financial planner. I have my own company, Freshly Financial Strategies, and I work primarily with real estate investors to help them understand ways that they can save on taxes and estate planning, and have a big picture of what their real estate holdings actually mean, instead of just having cash flow coming from real estate. So today we're going to go over the one big, beautiful bill act. I'm just going to call it the OBB because that's way easier than this craziness. But there are changes that took place in 2026. They're important for both you guys as business owners and for your clients that are purchasing properties. So I wanted to go over all of the changes that are happening and some of the extensions that happened as well. Because some things were set to expire and have now been extended or made permanent. So we're going to go through a lot of nitty gritty stuff today. If you have questions, as always, please ask. I hate listening to myself just speak for an hour. So if you have questions, even if you're on Zoom, unmute yourself, ask questions. I'm happy to answer. All right. So why this matters to you guys, obviously, you're not CPAs, but you are talking to people about taxes all the time, or they're asking you about taxes, which the answer is usually go talk to your CPA. But if you have some baseline knowledge, you can actually direct them in the ways that they need to be going. So your trusted guides, it's good to know the baseline of what has happened. So you can speak to a little bit and then say, go talk to your CPA. So the OBBA is major tax reform that got passed in 2025. Like I said, it extends and modifies some prior tax law. And then it gives us actually a little bit more certainty with planning because it made some things permanent. So we'll go through what it was made permanent. Otherwise, it was kind of like, got 5 years and then it dies. So now we have some permanent things that are going to be there for you guys as business owners and for real estate purchases. So big picture changes, again, more permanent, higher thresholds. So we'll go through what the higher thresholds are, meaning that your clients may be able to save a little bit more on the transaction side or on the back end from an estate planning side as well. And then fewer cliff expirations. So meaning that if you're an extremely high income earner, some of this stuff doesn't apply to you because you earn too much money and so you can't get a tax break on it. They did away with some of the cliffs, if you will, of how much you earn, not being able to take advantage of some of the strategies. So we'll go through all of that. I know that's a lot of small words that mean a lot. So realtors as business owners, we're going to talk about you guys and your business today as well. The QBI deduction was made permanent, qualified business income. We're going to go over what that is, what that means, and how the structure of your business matters for the QBI. It expanded the SALT cap, which SALT is taxes on your real estate. We'll go over that as well. And then why your entity structure matters more than ever. So we're going to go over LLCs versus S-Corps, because those are the two most common ones for self-employed people, and how it matters to you or to your clients and how you're filing. So QBI deduction in plain English. The deduction for qualified business income is up to 20% deduction on qualified income. I'm going to break this down into LLC and S-Corp in a little bit, but for right now, just easy 20%. This applies to almost all of you because you are all LLC, sole proprietor, or you have an S-Corp, right? None of you are W-2 employees. And then the income limits were expanded this year for this. So again, some people who couldn't have qualified for the QBI now can because of the expanded income limits. So LLC versus S-Corp. LLC, sole proprietor. Most people fall into this and then they file as an S-Corp, okay? From talking to the CPAs that I work with, most of them say once your income is over $70,000 per year, you need to be filing as an S-Corp. And the reason for that is you save on self-employment tax. Self-employment tax is 7.69% of your income. So if you're filing as an S-Corp, you save on that. However, there are caveats. So you need to work with a CPA if you're looking at that. So LLC, sole proprietor, obviously it's a simpler structure. All of your income is potentially eligible for qualified business income. So if you make $100,000, you could potentially have 20% of that be QBI. So 20% deducted, then your income is only $80,000. Your taxable income is only $80,000. So it helps reduce your taxable income. However, you are subject to self-employment tax. S-Corp, you have to have a payroll set up. You pay yourself out of your S-Corp and you generate a K-1. This generates W-2 wages and distributions. So typically how people do this, so let's use the example of 100,000 again. You do 50,000 in your W-2 and 50,000 as qualified business distributions. Well, when you look at the QBI, you can't take 20% off of the W-2. You can only take 20% off the 50,000. So that's why with the CPA, they'll be able to tell you what makes the most sense for you and your business structure. Okay, so I did this, but with 200,000 and different income structures. So again, example, if you want to take a picture of it and you're a visual person, net income is 200,000, potential QBI is 20%, so 40,000. Other taxable income before other deductions is 160,000. So you've reduced it by 40K. This is for LLC. For the S-Corp, we have a salary of 100,000 at W-2, a distribution of 100,000, and the QBI only applies to that distribution, so your total QBI would only be 20,000. Does anyone have any questions about the implications of this?
So you don't have additional deduction, you only have the 20%?
This is just up off the top.
Okay,
Yeah, this is before like itemized deductions before everything. So this is off the top.
so on both scenarios, LLC or S corp.
Yes, but the S corp, because typically you have W-2 income coming off of the S corp, that's the whole point of it. That doesn't get a QBI deduction. So your QBI deduction is less, but it might make more sense for you. Depending on how much you make, because you're not paying the self-employment tax on the S corp. So it's a game, but you need to talk to your CPA about that.
So you could potentially take less than a W-2, more in distribution.
Right. Right. So talking to your CPA about these things is really important starting this year because the QBI just went up. Before, it didn't really matter as much, but now as a business owner, if you're taking care of yourself, you need to be having those conversations with your CPA. Online, any questions for you guys? No? Okay.
Will you go back to the previous slide just real quick?
Yep.
Thank
Yeah, you got it. So the planning trade-off here for you as business owners, LLC, you have the higher QBI deduction that you can take. However, you have the higher self-employment tax. The S corp, you have a lower QBI, but you have a lower self-employment tax. So again, talk to your CPA. This is new and it's a new conversation and is necessary. Beforehand, the QBI wasn't as relevant because it wasn't such a big chunk. Like 20% is pretty massive for business owners. So also for you to know this as an agent. So for your self-employed clients, just making sure that they're talking to their people about this process as well, because they can be saving some money from a tax standpoint. SALT deduction changes. So the cap increased to $40,000 that you can write off. Property taxes are included in this, and then it phases out at higher incomes. We'll go through the history of the caps and what all of this means. So SALT stands for state and local taxes, includes property taxes plus whatever state and local income taxes that we have. And this only applies if you itemize on your tax return. Most business owners do, but a lot of W-2 employees won't. So this is for your kind of higher income or business owner clients. So what is the SALT cap? Why does it matter? Pre-2018, there was no cap. So we're kind of like fixing our own problem. 2018 to 2024, there was only a $10,000 cap. So, you know, around here where property taxes are insane, you could only get $10,000 of a deduction for your property taxes. Now, your clients who are in those higher income or tax brackets that have the nicer properties with the bigger property taxes, they now have up to $40,000 available to them with income phase outs. So if you're making like $10 million a year, sorry, you're going to be able to use it. But for your, Microsoft, Amazon employees that do standardized deductions, or they have above standardized deductions and they actually itemize, this can be a really good tool for them, especially for your real estate investors. Any questions so far about SALT? Super exciting. Okay. So who SALT helps and who it doesn't. It helps people with high property taxes, which is almost all of us, especially if you're in King County. Itemizers, moderate to high income households, and it has less impact for first-time home buyers. And then standard deduction filers, they won't see that, help them at all. Any questions about this piece? So, for your buyers, some things that changed and what didn't change. So mortgage interest deduction, reserves, that didn't change any, it's still the same as it was. The standard deduction is still really high. I think this year, I wanna say it's 28,000 for 2026. Don't quote me on that, I'm not a CPA. But the standard deduction is really high. So for single people who are W-2 employees, there's rarely a case where they would have to itemize. Mostly the standardized deduction will meet their needs. Like I said, itemizing is far less common for first-time home buyers, just because not typically a high income or a super complex situation where they have they need to itemize for something. Any questions on what changed and what didn't? So for sellers, capital gains from a federal level, we are not talking about state today. From a federal level, $250,000, $500,000 exclusion still is placed. That did not change. The dollar amount didn't change. The 250,000 is for single people and 500,000 is for married. What does change is a little bit of the timing. So for your clients, from a capital gains standpoint, you know, getting into a new year is always interesting. I have some clients who are trying to decide whether they were going to sell last year or sell this year. And because we knew that some things were changing for like QBI and SALT this year, we didn't make as many changes last year until they kicked in. So knowing what is happening, just being able to talk to your clients. And then obviously, like you guys know, planning before listing is key, making sure your clients understand their capital gains situation. I also have had clients come to me and say, and I'm sure you guys have had this too, you know, well, I'm buying another house, so I'm not gonna have any capital gains. That is not true anymore. That changed, I think, in 1993, something like that. But when you have people who bought in the 1980s and haven't, you know, sold a house or bought a house since then, you might hear that. So just educating your clients, making sure that they understand that 250,000 and 500,000 exclusion is only for primary residence. It is not for investments, and just be aware of those exclusions. Any questions on capital gains? I can talk about capital gains for like 3 hours. Super fun, yeah. Okay. So good news, 1031 exchanges, no change in that. Still do 1031 exchanges for investment properties. I will touch on this because it's something that I run into a lot, and I want to make sure that you're aware of too. So for 1031 exchanges, you have to exchange into what's called a like-kind property. Okay, so what that means is if you have a property, you have to exchange it into another real estate investment. For those of you who don't know this, there are funds called DSTs for clients who don't want to manage their actual properties anymore. They can 1031 exchange into DSTs. DST stands for Delaware Statutory Trust. And what it is it's basically like this huge pool of money managed by a property management company. The client gets a payout every month. My clients are making about 5.5% on their money every month. It's just like getting a rent check. They don't have to do anything. And they get to defer the capital gains. If they die, their kids inherit it, get the stepped up cost basis. It's real estate, it's exactly the same. So when you have clients who are like, I am done with renters, I don't want to manage it anymore. There are options for 1031 exchanging and deferring capital gains. Any questions about 1031 exchanges? I know you guys hear about them all the time. Good, okay. Opportunity zones. So this is a really, really big one. So opportunity zones, the last round of them, it just ended December 31st, 2025. What the OBBA did is made a new round of opportunity zones. We don't know where the zones are yet. We don't know what they are. But we do know that they start January 1st of 2027. Who can tell me what an opportunity zone is?
That's my question.
Basically, let's call it an underdeveloped or, I don't know, a place where they might be dilapidated buildings or whatever, so invest your money here. And you put your money in, has to be a certain amount, you have to put a certain amount of money into the property. And then it is tax-free for 10 years.
Yep, yeah, and at the end of the 10 years, then your capital gains are completely washed away too. So if you have people with highly appreciated property who don't want to do a 1031 exchange, but have about 10 years of a run-up and have the tolerance for something like an opportunity zone, it's a great way to get the deferral in for capital gains and get that forgiven after 10 years. So that starts in January 1st of 2027. That's new. Any questions about that online? You guys good?
When do the new zones come out?
Great question. I would assume they'll probably be out like Q3 of this year. I don't know for sure. I know they're not out yet. Yeah. But there's also going to be qualified opportunity zone funds, which are a good way for some people who don't have the appetite for like going and buying a property, like, you know, in a really bad area and on the same benefits. But yeah, I can let you guys know when I know about opportunity zones. I'll email Eric once I hear about it and let you guys know. And I'm sure that John or Scott will know pretty quick too. I talk to a lot of massive real estate companies who own these funds, and they're anticipating a lot more rural qualified opportunity zones in this next upcoming round, which will be interesting because the last one was not like that. It was more like inner city run down. So it'll be interesting to see why they think that. But these guys are the ones that like lobby Washington and, you know, like you're there all the time talking to them who know, so.
Well, that could be just like 100% tax play rather than
Totally.
I'm actually investing in a building that's gonna make some money. Kind
Right.
of thing.
Right. And so which is attractive for some people, right? It's like, okay, I, you know, throw up 10 houses on in a rural area in Marysville and I don't have the appetite for, you know, rehabilitating a place on Rainier Ave, you know.
Exactly.
It's a totally different play, but yeah. So we'll see what that looks like. But from who I've been talking to, they think that there's gonna be a little bit more in the rural zones too. Depreciation. Still valuable, very valuable. Does anyone know what changed with depreciation with this bill? So with this bill, they changed that you can fully depreciate a building in the first year that you own it. What that means for you guys as real estate people in this industry is an awesome opportunity to be able to fully depreciate properties in however many years you want now, because you can start doing it in year one. It used to be you had to do it for longer. And that goes against your income. So it erases your income through depreciation of your property. Not everyone has that. It is just people who work in real estate. So if you yourself are a real estate investor, you want to know how to fully depreciate a building that you own, talk to your CPA. It is only for buildings that were purchased after, I think it's January 15th of 2025 and onward. Okay. So that's the contingency for that. But anything that you now purchase can offset your income for tax purposes, which is killer.
So those are investment properties.
Investment properties, yep, yep. And then, once you fully depreciate, you can 1031 exchange into a new building. Do the same thing. It's massive for you guys in this industry if you have investment properties. I can't do this. You guys can. I can only write off like 20%.
It's better with like new construction though, right?
Depends.
Well, maybe not better, but more straightforward.
It could be, yeah, because I mean, you have to get the studies done on it and, you know, see how much you can depreciate, what it all looks like, but yes. A lot less problems, hopefully. I don't know.
Well,
Someday
you have
we
to
can-
have the exact costs.
Sure.
This is what it costs me.
Yeah,
This
yeah.
is what it's worth. This is, you know, so then it's very,
yeah.
Yeah.
Yeah, I think it makes the cost segregation study a little bit easier to do if it's new construction, because you just put it up and you're like, here you are.
Be crystal clear with you.
Right, versus like lines from the 80s, like how do you depreciate that, you know?
So that applies only to you personally, the real estate agent. You cannot be part of a, let's say, a LLC or.
It is, again, not a CPA, I always have to say this, but it's if you spend, I believe it's 4,000 hours a year in real estate. So that's what qualifies you as in real estate. So if you're like a property manager and that is what you do is real estate, it qualifies you. So if you're a part of an LLC that does real estate, you should qualify for it. But again, ask your CPA. Yeah. Any other questions about this? One of my favorite things
Like
about it.
100.
Yeah. This is one of my favorite things that happened in this bill was the full depreciation for real estate people. Like, it's huge, and so many people have no idea that it even happened.
it was there before though, right? The cost share.
It was, but it was, you could only depreciate. Last year, I think it was 50%.
Okay.
So the 100% is the new thing. 100% in year one has never been a thing before. But I mean, it makes sense because he's a real estate guy, right? Like that.
Yeah.
That's why there's so many changes that benefit for real estate, which is why I wanted to talk to you guys about it, because there's some good stuff. Okay, so we kind of already talked about this, but capital gains deferral for opportunity zones. Again, this is for 10 years, and then at the end of 10 years, you don't have any capital gains to realize. Potential tax-free growth, obviously the potential there is because not all zones are money-making zones. Some of them can just, you know, stay flat. But there are strict timelines. So when you are going into a qualified opportunity zone, you need to know what the timeline is. But knowing what they are prior to 2027 is really important because your clients get the full 10 years. Versus like 2 years ago, I was talking to one of my clients and they only got to defer for 2 years. And it's just not as beneficial for them. All right, estate planning and real estate, the estate exemption was increased like it does every year. This year, I haven't memorized the numbers yet, but it's only a few days into January. But if you have like really high net worth clients, last year, the cap was for a married couple $27 million. So this year, I think it's like 28.5 or something like that. obviously real estate is often people's largest asset, and they're like, oh, I won't pay estate taxes because I just have my home. Well, in the state of Washington, our estate taxes start at 2.1 million. So if you have a client with a $1.5 million house, chances are their total estate is over 1.5 million. It's over 2.1 million per person, right? So making sure that you're having discussions with them of what's the potential outcome of estate planning processes. If you have a bunch of properties, what does this look like? Are we putting in trusts? Are we putting in LLCs? What does it all look like? And then, for the love of God, titling matters. I know you guys run into this often, but how clients title their properties really does matter for an estate planning strategy and just in general. So taxation, trusts are taxed differently than privately owned property, than LLCs. So if they have their home or an investment property owned by an LLC, making sure that they have their insurance covered by the LLC as well. So titling is really important. And when you're going through, especially from a investment standpoint with clients, making sure that their stuff is titled how they want it to be when they're going in. The other thing I run into with titling is when you're breaking up an LLC to do a 1031 exchange, you have to, if you're doing a 1031 exchange in an LLC, the 1031 exchange has to be in the exact same title in the new building. So one thing I've run into is Tony and I have a joint client, 5 siblings. They have an LLC together. They're in their 70s. They don't want to manage the building anymore. They want to do a 1031 exchange into a DST. We have to retitle the current property to all 5 of them in their own, however they want to do it, personal or LLC, before we're able to 1031 exchange and split it all up, or else it's all going to be together. So being aware of those little nuanced things is really important for your clients. Any questions about that? I heard a buzz online. No. It's good.
I think I don't understand the reason. Why do you need to do that?
For 1031 exchanges specifically.
It cannot just be.
So in the example that I used, like the 5 siblings don't want to be in business with each other anymore. And
Oh, okay, they wanna.
they want to basically like they want to separate their estates.
Okay.
Because
That
it's
makes
all
sense.
tied up in this $13 million property. Yeah. Good question. Any other questions on that one? No. So obviously avoid making tax promises or saying exact numbers. Tell people, this is the concept, but talk to your CPA. You guys know this. Legal conclusions as well. And then specific dollar outcomes. I personally stay away from these as well. Just like I told you guys, kind of round the ballpark of what the number is. But just make sure that people are talking to their CPAs, because these are really good strategies for people, but they need to talk to them. I need to talk to them. And obviously your value add is education for your clients, especially for this year with some big changes coming in. So your middle to high net worth clients will see a lot more tax benefit from the SALT and the QBI, especially your business owners for QBI. And then just making sure like what they're selling is in good timing for them. And I think I've heard most people in this room tell people it's not a good time to sell or buy based on, one factor or another, and just making sure you're continuing to do that. And then obviously referral partners. If you guys need good CPAs that do real estate, let me know. I have a couple, they're awesome. But all CPAs are not created the same. Some of them do not do real estate very well and they just file taxes. So just make sure that you're using someone that actually knows what they're doing and knows all of the new things that are too. So key takeaways, we have a little bit more certainty because these things are more permanent. Qualified opportunity zones, we've been told, are going to continue to be around. There's more opportunity for you guys. There's higher deductions for higher income earners means that they can spend more money on the actual house that they're buying, perhaps, because they're saving on property taxes. And then obviously it allows you for more collaboration with CPAs, financial advisors, whoever, to work through these new things. All right. Anybody have real life scenarios that we'd like to talk about? You guys all love talking about OBBA.
That's great.
It's a lot of information, but I think that if you just know the baseline and you can kind of direct people in the right direction, it's good information to have. Cool. Any online questions? You guys good? It's Zoom. All right. That's all I got. You guys got no questions? All right.
Thank you. Thank you.
So.